Implied volatility crush, otherwise known as IV crush, is when your options premiums collapse due to a sudden decrease in implied volatility, sometimes resulting in losses even though you correctly guessed the direction of the underlying. Now, this is a hot topic of conversation lately because implied volatility is inversely correlated with the direction of the underlying. So in other words, if an underlying's value goes up, implied volatility tends to decrease. As it goes down, implied volatility tends to increase. So you can see why that's a problem here. If we're looking at the stock market recently, you can see as it collapsed, implied volatility increased to record levels. But now that we're experiencing a little itsy bitsy bounce, implied volatility is collapsing pretty significantly. So if you're trying to buy calls right now, capitalizing on this bounce, you might experience that this decrease in implied volatility outweighs any gains you make by correctly guessing the direction of the underlying. So how can we hedge against IV crush or Vega exposure? Well, there's 3 ways to do it. The first way is through spreads. Now, if you aren't familiar with spreads, I recommend you watch the tutorial up in the corner. This is not gonna be a tutorial, but it is gonna explain how spreads limit your Vega exposure. Here we're looking at 2 different calls. We have a 273 strike call and a 274 strike call. And down below we have the Greeks. Let's say you wanna go long in the underlying stock, but maybe you're not comfortable with the Vega exposure you have here. Now, this isn't really exceedingly high. Most of the time, the highest Vega exposure comes from having a bunch of out-of-the-money options. Even though a single out-of-the-money option doesn't have very much Vega, the Vega is pretty small, a bunch of out-of-the-money options, which are cheap, are gonna have a very high Vega and expose you to a very high potential for IV crush. With this call you buy, there's someone out there that sold it to you that's experiencing the exact opposite thing you're experiencing. When you make $1, they lose $1. And that pertains to when you make $1 when implied volatility increases. You make $1 when IV goes up, they lose $1. It comes from their pocket. So when you sell a call over here, you're not experiencing these Greeks, you're experiencing the exact opposite of them. So when you have a 13 Vega, you have a negative 13 Vega, a positive Theta, and a negative Delta. The resulting overall position is that you basically have a 0 Vega. Now these numbers are rounded, so you'll have a little bit of a Vega, and it will change as the underlying price changes, but most of your Vega is neutralized, and whatever's left over is gonna be so small it won't even matter. Your Theta is almost neutralized as well, although it's rounded like I said, so it's about 0, but that's also gonna change a little bit, and it's gonna be less significant when your strikes are further apart. Your delta, however, is going to be reduced significantly, and this is reducing your overall leverage, which depending on your confidence in a position can be a bad thing. When thinking about hedging your position like this, it's important to understand that at-the-money options have the highest Vega, and you can see that here on Webull. And Webull is a brokerage that I don't personally use. It's in between like Robinhood and Thinkorswim. So if you want to support the channel and try it out, links in the description, add $100 and you'll get 2 free stocks. So here we're looking at an options chain and you can see that right here is at the money. This is the current stock price or ETF's price. And these are all the strikes of the options. But you can see Vega increases as you get at the money and decreases as you get away from the money. Vega is the highest. You have the highest Vega exposure when you buy just an individual option when that option is at the money. Well, what does that mean for spreads? Well, it means that whatever leg is closer to being at the money is going to have the highest Vega and it's going to determine whether or not you're long or short volatility. So let's say your 273 strike call is closer to being at the money and it has a 0.13 Vega, and your short 274 call is away from the money, and let's say it has a 0.12 Vega, because as you get away from the money, your Vega decreases. Well, this is going to result in you being long 0.01 Vega. So you're gonna be long volatility. So overall, you do have long exposure to volatility, but it's very, very small. Now, this is gonna be more significant when your strikes are further apart, like I mentioned. And if your short leg is closer to being at the money, this is going to be negative. But regardless of what happens to your position, whether it's in the money, out of the money, at the money, whatever, when you're trading a spread, your overall Vega exposure is gonna be reduced significantly, and this is gonna reduce your potential to be IV crushed. Maybe you don't want to use spreads because it's going to reduce your overall leverage. Well, what do? Well, the second way to hedge against IV crush was actually brought to my attention through a post on Wall Street Bets, believe it or not, where a guy claimed that you can hedge your SPY calls using VIX puts. And he's kind of right, kind of wrong, but kind of right. So let's discuss how this works. Well, the VIX is a volatility index that tries to follow implied volatility on SPY options. So you can see this historical implied volatility chart that we were looking at earlier. And over on the left, you can see the VIX, which very much mimics our historical implied volatility. And you can trade options on the VIX, which is how we're going to end up hedging our Vega exposure. Well, here's how we do it. Let's say we have a SPY call, and they're the Greeks of that SPY call, and we're a little bit nervous that we're going to get IV crushed as the underlying increases in value because we expect implied volatility to decrease. Well, what we can do to hedge our position is buy a VIX put that has a delta equal to our Vega of our SPY call. And you'll see how this works here in just a moment. So let's run a bit of a simulation here. Let's say we were correct in the directional assumption of our underlying, in that SPY increases by $1. But as it does, implied volatility decreases by 5%. Well, what happens? Well, as SPY increases by $1, because our delta is 50, we're going to make 50 bucks. Of course, this is estimated. Delta is going to change by a factor of gamma as the underlying moves around. But let's say we make 50 bucks and it, delta doesn't move. That's great. But as implied volatility decreases by 5%, we are going to lose 20 times 5. So we're losing $100. Okay, so that's what happens over here. But we bought a VIX put to hedge this implied volatility crush. So what happens over here? Well, because VIX tries to mimic the implied volatility of SPY options, as implied volatility decreases by 5%, VIX is going to roughly decrease by 5 points. So if it decreases by 5 points, we're going to make $100 because our delta is minus 0.2. This negates the IV crush we experienced and leaves us with our profit from having a positive delta. Now this is great, but there are a few issues with it. The first is you're doubling your theta. Both of these options are going to have theta, and that means over time now, you're going to be exposed to more time decay. In addition to this, you're going to be doubly if the underlying decreases in value. Because your delta is positive, you're going to be losing money this way as the underlying decreases in value. But as the underlying decreases in value, the implied volatility is going to increase, which is bad when you have negative delta, so you're going to lose money here as well. So although when you are correct, if the underlying moves upwards, you are roughly Vega neutral. If it goes down, you're doubly exposed to losses. Now, the third reason it's not great is because while you might be Vega neutral for a hot minute, the Greeks do change around. So you will have to come back and adjust this so that the Vega matches the delta. Otherwise, they're going to get not quite offset enough. They're not going to offset each other perfectly. So it requires tweaking is best used in shorter time frames. Just be aware when things go down, you are very much exposed to pain from both ends, from the SPY call and the VIX put. But if you're super confident in the upwards direction of the underlying, then this is a good way to hedge yourself against Vega exposure. Okay, so the third way you can try to avoid IV crush is by buying in the money options. As we discussed, at the money options have the highest Vega and therefore the highest exposure to changes in implied volatility. This means as you get further out of the money or further in the money, what ends up happening is you have a smaller Vega and overall smaller exposure. So here on Webull, you can see that. On the left, we have Vega. As we get further out of the money, we have a smaller Vega. At the money is the highest, and the further in the money we get, we have a smaller and smaller Vega. So if you buy an in the money option, if it's not going to take your entire account to do so, you're going to have a lower chance of being IV crushed. But why not just buy out of the money options? You can go long out of the money options if the stock price increases quickly, which it could, given current market environments. You could make quite a lot of money while still having a small Vega. Well, here's why you don't want to do that. For an example, we have an in the money option here and out of the money option. Premium is $8 for the in the money, $1 for out of the money. The Vega is 0.13 for in the money and 0.2 for out of the money. There's two reasons why you will not want to buy an out of the money option. The first is a lot of people will just buy a bunch of out of the money options. So if we buy 8 of these, they're going to cost the exact same as this single in the money option, but we're also getting 8 times our Vega. What ends up happening is we pay $8 in premium, but we have a 0.16 Vega, which is higher than the single in the money option. So that's how you can expose yourself to a higher Vega. Another reason you don't want to buy out of the money options is because as the underlying increases in value, your Vega is going to increase because your options going to become closer and closer to being at the money, which is going to expose you more and more to IV crush. So if you were going to buy a single option but want to have the least exposure to Vega, don't buy out of the money, don't buy at the money, because that's going to have a high Vega. Buy in the money. You can even buy an in the money option and sell a cheap option against it and create a spread that has a really, really wide strikes. That way you still have plenty of leverage, but you've actually reduced the cost of the trade and you've reduced the overall risk of IV crush. That's really the benefit of spreads, is you can really fine tune your exposure to things. The last thing you want when you're trading is to be caught by surprise. When you guess the correct direction of the underlying, you don't want to lose money. I hope this gives you a few ways that you might hedge against exposure to changes in implied volatility and avoid the dreaded IV crush. Thanks for watching, guys. I'll see you in the next one.